Hi everyone. Today let's talk about option position defense. This is certainly a relevant topic given that the markets are a little turbulent right now, and let's figure out exactly how we want to handle these positions. In my last options video that I did on Sunday, which you should definitely check out if you are an options trader, I talked about this chart and I want to use it to expand on some of the ideas that I'm going to talk about in this video, again centered on option defense and how to think about options in a more effective way. And then I will use AMD as my example because it is a position that I'm defending right now. If you like trading stocks and options and making money, definitely like and subscribe. I make 2 to 3 videos every single week going over all kinds of financial topics as well as my options portfolio and stock portfolios. So definitely like and subscribe so you don't miss out on any of that content. Welcome to the Portfolio Bulletin. Let's get started. So let's start with how I got into this AMD position and when I got in and why. So you can see here it's dated February 23rd, and it was cleared at 10:15 Central Standard Time. And this is a put credit spread that got filled for $1.64 or $164 credit. The spread was the 75.65 credit, so I did a 10-point spread, meaning I put up $1,000 to make $164, so my max loss is $836. If the stock were to close below $65 on the day of expiration, which is April 16th. It's worth mentioning here that I did risk a little bit more than I probably should have. I could have done a 5-point wide spread and given myself a little bit more room to maneuver, which is something I will probably do in the future, as the optimal amount of cash to risk in terms of a spread is somewhere around 6 to 7%, meaning that if your stock is a $100 stock, you should risk around a 7-point spread. This gets a little bit tough when you're in stocks that are around $80 like this one, because these usually roll in sets of 5, and it feels like you're not risking enough if you only go 5 points wide, but that's a decision that you have to make. For me, I went 10 points wide just to make sure that I'm covering that 6 to 7%, and it also gives you a little bit bigger credit to get started. So let's look at the charts and see exactly when I got into this trade based on the price action. So this is the hourly chart. And you can see we hit some highs here on February 16th at $93, top price at around $94 for highs. And then we had a pretty decent sell-off. So we had a sell all the way through February 17th, recovery here on the 19th, and then a further dip here on the 22nd. And then here on the 23rd, this is where I got in. So looking at the exact time that I got in here, the execution said it took place at 10:15. So somewhere in this candle on the downtrend is where I got into this trade. Somewhere around $83 is where the stock was, down from $94. So notice here that I'm not taking the trade at highs because that is a risky trade. Anytime you're selling a put at highs, you're assuming some additional risk unless the stock is really deeply undervalued. But zooming out here, you can see that it's had a pretty decent topping formation that's been forming since around December 1st. Got up to this price action all the way up to actually around $97 here on December 16th. And it touched this price a couple of times, sold off a bit, recovered, sold off a bit, recovered. And then we got that sell off into where I entered all the way down at around $83 down here. So when you see these rejections out of these levels around $97, it's definitely not the time to be selling puts, as that definitely puts you at more risk. So you can see we established that level up here. Came down, came back and retested that level and we got rejected and actually made a lower low here. So we have a low and then we created a lower low and then we had a lower high. This high is lower than the previous one, meaning that this is potentially generating a downtrend and then a lower high. And then we really had a decent sell off all the way down to $83. And at this point, I started to look at the fact that I could sell options around $75. And we had already come down from all-time highs over here at $99, just short of that $100 mark. So it's definitely worth looking at these bigger price action trends when you're looking for new positions. It can definitely give you a little bit more defense and a little bit higher rate of success. So zooming back in here, you can see it did recover from that point, and I probably could have taken some profits in here, but I did not. Came back down, retested that level, came back up. And we had a lower high here versus this previous high. Again, continuing this downtrend. And then we sold off heavily, right? So we came all the way down into that 75 level, got a rejection out up to 78, all the way back down past my strike to $74, came back up to $80 a share, and we're right now sitting at $77.60. And I did roll that option out, which I will show after this analysis. But I want to mention here, the stock went from $83 where I entered this position all the way down to $77 right now, which if I was trading 100 shares would be around a $600 loss. But because I'm selling the puts and trading options on a credit spread, I didn't lose that $600. And that's part of the benefit of options. My break even is actually all the way down here at around $73.70. So we didn't actually even touch my break even point all the way down here. And as long as this stock stays above my credit spread, then I will at least make some money, if not a max profit. So let's talk about the roll that I did. I actually did this roll today, and I did it for a credit of 5 cents. And this is important here because it was done for a credit, but I actually rolled this down and out in time. So I bought back my credit spread, which was the 75.65, and I sold the 73.55. So I did put a little bit more money at risk here. I actually put $1,800 at risk. So this is now an 18-point wide credit spread, but it's actually a little bit lower in terms of a break-even price. So I got a $5 credit, and my other credit was $164. So my total credit here is $169, and I'm currently at the 73 strike. So my break even now is at $71.30 instead of the $73.70 that I was at before. So basically what I'm doing here is I'm putting a little bit more money at risk in order to roll down and get a little bit of a credit. Now be aware that this is putting more money at risk overall, and it increases my max loss. So this is not a trade to take if you're not confident that the stock that you're trading is going to be worth more in the future. Basically, you're doubling down, putting more money at risk to get a bigger credit and lower your break even to give yourself a better opportunity to make money. Of course, there's potential that AMD continues to sell off, and I've put myself in a worse position here than I would have been if I just took my max loss on my previous trade. My previous trade max loss was right around $850. And now I'm risking $1,800 in this trade, so my max loss is closer to $1,600. Another thing that you could do here to defend your put position, which is not something that I've done in this case, but is definitely worth looking at, is selling a call credit spread. So in this case, I'm looking at after hours pricing, but it's still valuable. I'm selling the 83 call and buying the 85 call, which is only a 2-point spread. But for that 2-point spread, I'm getting $1.15. That pricing seems a little ridiculous, and I'm not sure why the credit is so large for only a 2-point spread. But what this is doing is adding to your credits without adding any upside risk. So because this is only a 2-point credit spread, and we received $1.69 already on the put credit spread, and this is giving me another $1.15, that means my total credit here is $2.84. So because I've received $2.84 and this credit spread is only $2 wide, even if I hit max loss on the upside, I won't lose any money. And in fact, at max loss on the call side, I will still make an 84-cent profit. So I don't have any upside risk by taking this position, and it further improves my position on the downside, which would drop my break-even price closer to $70 per share. The trade-off here is that if the stock rallies and closes above my $84 strike here, I won't make as much money as I would if I didn't have this position on. But again, you're taking this trade in order to reduce your downside risk without taking any additional risk to the upside. Also, I want to mention here, this is kind of a last resort in terms of protecting your put position. You can also pay a debit to roll down. So this is a credit spread, so we generally prefer not to pay a debit, but it is something that you can do to protect your position. So what I'm doing here is taking my position at the 73.55 put credit spread, and I'm paying $1.15 to move that down to the $70 put to $50 put credit spread. So what I'm doing here is moving my break even down from where it was at the 73 put to the 70 put, and I'm doing that for a cost or a debit of $1.15. Now remember, my original credit was $1.69 after the roll. So overall, $1.69 minus $1.15 is still a positive credit, and I could still potentially make money on this trade. And I'm further reducing my break-even price just to give me another tool to increase my probability of profit. Again, this is not the preferred method, but if you get into a bind, definitely make sure that you keep this in mind because it can protect you from losses. Going back to the charts here, I did switch this over to the daily chart just to give you an idea of where we're at in terms of price action. You can see going back to July of this year, we were priced around $54, $55 per share. We had a massive run in July and August of 2020, all the way up to this price range that we've generally been chopping around in for the past couple of months. And we're coming into what looks like a support level here, right around that $75 price, which most likely is why I chose this price back when I opened this position. But of course, there's nothing that says this price won't break down, and we could retest somewhere in this mid 60s. And this is why it's important for you to choose stocks that you're actually interested in holding. I think AMD will be more valuable going forward. I think they are taking market share away from Intel and potentially challenging Nvidia. And this is why it's important to have an underlying thesis on the stocks that you're trading, and not generally picking stocks out of a hat, because you're more likely to panic out of a trade, which leads me into the next chart, which I mentioned briefly in my last options video. So going back to this chart that I mentioned in my last video, this is stock price versus the value of a put credit spread. Based on the price of the stock, I think this is probably Tesla, and this is a 60-point spread, so they're risking $6,000 here. And based on the break even, they got around $18 for that credit. So they're actually risking a little bit over $4,000 or $4,200 to take this trade in the attempt to make $1,800. And you can see the stock price was right around $710 when they entered the position. And immediately the stock went way up to around $730 or $740, giving them a $500 credit right off the bat, giving them a $500 profit right off the bat. So if you see a $500 profit out of a potential $1,800, meaning you're getting close to a 30% profit right away, don't be afraid to take those profits early on. They have days to expiration here, starting at 67. If you have 67 days to expiration and you're already at 1/3 profit, it's a fair bet that you should take those profits and look for another entry. And that's exactly what happens here in this scenario. So he hits that high profit, and then the stock retraces those gains to newer lows, touching the strike price right at $700, putting him into a little bit of a loss. So you can see the put credit spread is now worth more than what this person sold it for, even though the stock price is well above the break-even point. So if this person panicked and sold out of this position, they would realize these losses even though they're not actually taking a loss at expiration with this credit spread. And sure enough, the stock recovers. You see a small profit here, probably not taking this profit. It's a little bit too little for me to realize those profits, but you never know. If you're at a pretty big losing position down here at minus $500 and you see a small profit, it's not a terrible idea to take those profits and maybe look for a little bit better entry. But again, this is looking in hindsight, so you never know. So you never know whether this stock is going to rally into what we saw over here. So the stock comes back down and touches $700 and rallies all the way up to around $760. Again, if you see this kind of profit with 45 days to expiration, you're basically at max profit at this point. Definitely take these profits at that point and look for a better entry. The only caveat here is if the stock is continuing to rally aggressively, then you could potentially miss out on some gains. But one of my favorite sayings is you can't go broke taking profits, and there will always be another opportunity. Sure enough, the stock retraced all the way down to the break even at around $682, putting this person in a loss of around $750. But remember, the stock is only at his break even here. So again, at expiration, you would take 0 losses if the stock settled at this point. But if you panic out of the position, you're going to realize that $750 loss. And remember, one of the strengths that I talked about previously is the fact that you can enter this trade at around $720 and you can make money all the way down to $682 at expiration. But that doesn't work if you panic out of these positions and don't give the stock time to recover. And that's not to say that there aren't times to exit, because there could be a massive sell-off. For example, if something changes in your thesis and now the stock is not potentially going to fulfill your long-term goals for it, then it may be right to get out of that position. But if the stock is just going through some short-term weakness, you still believe that the stock is going to be worth more in the future, definitely don't panic out of these positions if you have to defend the stock in a way that I mentioned previously, or just continue to take in credits rolling out in time and and rolling down your break-even price over time and waiting for the stock to recover sometime in the future, you should be willing to do that if it's a stock that you have chosen to trade, especially when it comes to options. And then fortunately for this trader, the stock recovered and settled well above his strike price of $700, resulting in a max profit of that $1,800 that we talked about. And I can tell you this has definitely happened to me several times. A few times I have been the guy that panicked out of this position just to watch the stock recover, but several times I held that position realizing that I wasn't in a losing position and it was a stock that I wanted to own, and I held the position and it turned into profitable trades. Obviously, this is all hypothetical, but these are certainly scenarios that I've experienced since I started trading options around December of 2019. So that was a lot. Definitely watch this video a few times and understand how I'm making decisions. Definitely look at the defending portion as well. If you get caught up in a position where you could potentially lose money, there are ways to continue to make money while stocks go against you in options, and that is the main benefit. You don't have to be right all the time, and as long as you're right sometime in the future, when it comes to options, you can make money. But if you continue to panic out of positions, or put yourself in stocks that you're not convinced are going to be worth more in the future, or don't recognize when it's time to leave a stock, if perhaps your thesis has changed, then it may be a difficult time for you trading options. All of this takes time and experience to learn, but hopefully this video is beneficial. If you got any value out of it, definitely like and subscribe. I do make videos like this and around other topics like trading GE over the course of the year, or my general options portfolio and things that I'm looking at for upcoming trades. Definitely subscribe and hit the bell so you don't miss out on that content. Of course, none of this is financial advice. This is all for entertainment purposes, and have a great day.